Yeah, I would. You're de-risking the deal, so there may be a more secure return and potentially, depending on what the equity.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Structure is like more cash flow to investors, but I would say generally we're going to see returns go down, all things being equal today, given we're coming in at 60% leverage rather than 70.
Paul Winterroad is a commercial real estate mortgage broker that provides solutions to the entire capital stack. He's also an experienced investor in commercial real estate, having been a part of over 40 deals. Paul, welcome to the show.
Sam, it's great to be here. Thanks for having me.
Absolutely, Paul. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
Working with investors to help them with financing solutions. In the back of my mind, the goal was always to leverage that into investing. Myself, I thought that would probably take 10 or 15 years. I'm now 8 years in the business, and I got involved in investing just due to the network and associates that I'd created. I started out as a general partner on some small multifamily, like 20 to 60 unit range, and did the whole shebang there. Also did a self-storage deal, but given the time and everything involved in conjunction with the day job, if you will, have transitioned into more of a passive investor limited partner. So
why did you choose to go the commercial mortgage broker route versus, say, the commercial broker, real estate broker route?
Yeah, I was really in where my interests lie. I had always had an interest in finance, and as a commercial mortgage broker, I get to do marketing, I get to do analysis, I get to do problem solving, and just like the finance side of it better, and just was better suited for my skill set and my interests. It's worked out well.
Is there a particular asset class that you focus on?
The bulk of my business has been in multifamily. Done and all types of multifamily, but then a little self-storage as well in the career, and some commercial retail.
Gotcha.
Financing.
Right. Understood. Well, this is a timely conversation then, because obviously, the markets are in, I wouldn't call it severe flux, but they're certainly in flux. And especially when it comes to the debt side of things. So tell me, what's your take on the capital markets right now?
Yeah, it's been such an interesting year because it's moved so fast, and we could spend an hour unpacking this, but in a nutshell, the game has changed. There's definitely a disconnect between buyers and sellers, simply because what buyers are able to achieve in the capital markets from a leverage standpoint has dramatically changed. So a lot of bridge lenders, which was a very common acquisition tool over the last couple of years, have pulled back. Some are out of the market, but others are far more conservative, where it was doable to get an 80% loan to cost type scenario, whereas now, with where pricing is on the buy side, it's really challenging to get much beyond 70%, and we're seeing stuff size at 55% leverage, simply because of the bridge lenders, construction lenders are looking hard at that takeout, as far as what is this permanent debt or the stabilized financing going to look like on that other side, and they're applying 7% interest rates in some cases for those exit tests, and that we don't know exactly where it'll be, and rates are inside of that by and large for permanent financing now, depending on where and what you're doing, but that's it's just a challenge. So you either got to come up with more equity, and so we're looking for and helping people with solutions on a creative capital stack. So other layers, whether it's C-PACE financing, mezzanine financing, preferred equity to help bridge that gap from where the debt markets are.
That's really interesting. I guess maybe if you can clarify my thinking on this, but so you've got bridge lenders, which you saw a lot of that, and you said that the bridge lenders are kind of de-risking their portfolio, if you will, by lowering the amount of money that they will lend. Is part of that also driven by, because of the higher cost of capital, there kind of comes this tipping point where equity is almost, where the deal could actually have better returns. Tell me if I'm thinking clearly here, but deal could actually have better returns with more equity in it and less debt. Is that part of the equation as well?
It is, and it's a case by case scenario. So typically, when you run the numbers, the more debt you can get, because it's a lower cost of capital than equity.
Right.
You're going to increase your return. So your IRR will go up, your equity multiple will typically go up the more debt you can get, because if you can borrow at 5 or even 7 or 8%, that's better than an equity investor who's going to want 15 to 20% and a 2x multiple. So I would, you're de-risking the deal. So there may be a more secure return and potentially, depending on what the equity structure is like, more cash flow to investors. But I would say generally we're going to see returns go down, all things being equal today, given we're coming in at 60% leverage rather than 70, for an example.
Yeah, no, that certainly is like you said, on a case by case basis, but that's in one of the asset classes we're investing in right now. We're looking at that pretty long and hard, going, gosh, what does this look like if we just did this in all equity and said, hey, you know what, we're gonna take risk off the table. Yes, it'll mute your returns overall, but if we completely eliminate risk, okay, at least on the debt side of things. I mean, you still have your
those conversations are occurring, Sam. I've heard other folks just bring that into the equation these days of, well, if the bridge or the construction loan is 10%, because they need non-recourse,
right?
And maybe it just makes sense to raise it all and then put the perm debt on and return the capital at that point. So that is part of the conversation these days.
Yeah, it's an interesting one that I probably didn't see coming, but it certainly is a one that is entertaining, at least to that. And I know we've talked about that term here. You're the second or third person probably in the last 30 days that's mentioned that cash in term, not one that we've really talked about in the last 10 years. So
No.
if you can just quickly maybe give us a high level view of what a cash in refi is.
Yeah, it was a simple little deal here. I'm in Salt Lake City, Utah. It was a local deal, mom and pop sponsor. Actually helped him acquire the property with a bridge loan from a local bank. We did a 75% loan to cost. So that was the purchase price plus the rehab. We did a loan for 75% of that. And everything looked great. We assumed that we'd have some sort of permanent financing at around 4% and could pull some cash out even at that time. It was a 12-month bridge loan that was used to acquire. They executed their business plan. Really in that 12 months, they got it rehabbed and stabilized. But where interest rates were now at the time we did the loan, closer to 6%, because the permanent loan is based on the net operating income and hitting at least a 1.25 debt coverage ratio, there was a shortfall. And so luckily it wasn't too big of a deal. It was a little painful, but they had to bring 150,000 or so to the closing table. And what happened is they essentially moved some money out of the stock market. They had a decent liquidity position, which again is important to have. But that's what happened. In order to secure the permanent financing, they had to bring in some cash to satisfy the higher bridge loan, because the permanent loan didn't pay it all off.
Did the permanent loan come in at a lower LTV I guess if that's the right way, right? LTV on that.
Yeah, the value was not a concern at all. So when we're looking at loan sizing, how large of a loan we get, there's loan to value constraints. Sometimes there's loan to cost, but there's also debt coverage constraints. So based on the in-place income, the interest rate and the amortization, you solve for a present value when you get those factors in, and we just couldn't get there. So if we were still in a 4% interest rate environment, it wouldn't have been a problem at all. But because it was a couple percent higher, it necessitated the cash in.
Right, right. Yeah, your debt's costing you 50% more than it was
Yeah.
originally projected. So that is really, really interesting. Paul, I've got a question for you. I want to kind of circle back to the capital stack conversation as a whole. I know we've talked a little bit about how the debt market is shifting, kind of what you're seeing. How are you helping your clients on just the entire capital stack, and how is that shifting?
Yeah, so I work with a company called StackSource, and in a nutshell, we really want to be able to provide solutions for all types of commercial real estate. We've done loans that are 200,000. We did a $140 million complete capital stack project last year as well. So there's nothing really too big or too small. And our technology, we've built this database of over 1,700 different lenders and loan programs across the nation, again, for all types of commercial real estate finance. And so our technology, when we enter in the information on a deal, narrows down to who the players are, what lenders meet that criteria. And so it helps us find the best lenders on the debt side. But we do, like our name says, StackSource, we want to be the source of the complete capital stack. So we have a team that sources institutional equity. So when we say institutional, those are typically large checks. So we're looking at projects in I'd say in the 40, maybe 35, 40 plus $1 million range, where these equity checks are coming in anywhere from 5 million and above. And there's a fairly robust market for that. Now, the middle market, more the friends and family, it's a tougher space to source, quote unquote, institutional equity. And it may not be a right fit for a small mom and pop, but there are a handful of equity providers that we have that can come in on a more of a small balance basis, maybe a 500,000 to $5 million type check. And so where this really applies is, hey, of course, if you're syndicating, or source your equity or capital from friends and family and that network. When you've grown to a point where that doesn't make sense, we can come in and help with that. There's also and this is going to emerge more and more as we get into this cash in scenario, where lenders will offer what is called a mezzanine piece. And that's really a fancy word for a second mortgage. Now that's not cheap money. Right. So usually the lender will provide, let's say a 60% senior loan, and then you want to get to 70%. Well, they'll do the next 10% of a mezzanine loan, where the senior may be 6% interest, the mezzanine may be 12 or 13 or something. So it's only 10% of the capital stack. It does increase the leverage, and then you look at a blended rate, and maybe you're all in at 7%, but it does help push that leverage. And it's, again, a cheaper cost of capital than that equity may be, that's expecting a 15 to 20% return. And there's also an emerging financing tool called C-PACE financing. Don't want to get lost in the weeds, but for projects that have a green component or a sustainability component, that's another element we can weave into the capital stack. and have done so, especially on some of these larger projects.
I mean, having the tools and resources to navigate a lot of these different ways of kind of putting these deals together. I mean, it seems like, and again, that's why I'm gonna call it a job. But like you said, you're not looking to trade in your day job. You love what you do, but that's why you do what you do. I mean, because people can come to you and say, "Hey, look, we've got a really unique. How do we solve problem X,
Yeah,
Y, Z, and get that done?" I mean, that's just by the time you get done with, like you said, dealing with C-PACE financing, mezzanine debt, putting all these pieces together, it kind of goes beyond the capability, I think, of most sponsors when it's like, hey, we can raise capital from friends and family. We may be able to do it even in the tens of millions at a time, but at some point you get to a fork in the road where it's like we're working with a different beast at this point.
yeah.
I think that's why you have a job. Tell me a little bit, and appreciate that. Thank you for taking the time to certainly break down the different ways that these can be
Sure.
handled. 38 LP or 40. I can't remember which one you said, 38 or 40.
I think 38 is where we are. So
Okay,
don't
38.
give me more credit than I deserve. So
Okay, somewhere I think maybe in your bio those 40, maybe it was 40 deals altogether, but you're in 38 investments as a limited partner. What has that experience been like? And I guess where are you putting your money right now?
yeah, I've loved it. So as we read Rich Dad Poor Dad, that's like the gateway drug for most real estate investors. And he talks about this passive income, and
Right.
it's you get in the trenches, you start flipping houses or managing a fourplex, which I did, and then you even get on the GP side, and you're like, this is a full-time job. There's nothing passive about this.
No, no, there's not.
So again, we mentioned I really do enjoy what I do for the quote unquote day job, and it provides me almost an unfair advantage to just a network of people and opportunities for LP investments, which have been great for me. But yeah, as I realized the GP stuff was a second full-time job, I took some of those profits and said, okay, I'm just going to roll this forward and start investing in other deals. And I started out always like the minimum 50,000 type thing, and wanted to try out different sponsors. I wanted to see what they were doing and what made sense and what worked. And I've had a handful of exits, which have been great. The last couple years have been robust. A couple were in the 3x multiple
Wow.
range, and that was a lot of fun. But I just set that money aside, and it's like my self-directed IRA, even though it's not an IRA. There's no sense in doing it in an IRA because of the tax advantages real estate provides. But that's what I've done. So different sponsors across the country in different markets that I have familiarity with and that I like. I've the vast majority has been multifamily. I've dabbled in oil drilling, and I have also dabbled in a Bitcoin mining fund, neither of which I'm too thrilled with, candidly.
They're both a
I
bit
guess I'm
speculative.
better at sticking with what I know. We'll see if these things come around, but and right now, I am more like I've got a lot invested, but as I haven't been quick to redeploy over the last 6 months, as a couple deals have come full cycle. I'm just picking my opportunities. So I'm kind of in cash at the moment. I'm not opposed to investing, but it's got to be a good deal. And one thing that I think is important for everyone listening, and any deal requires and you should put in a fair amount of due diligence, but you can really cut to the chase in about 3 minutes by looking at the exit cap rate and NOI growth assumptions. So we don't know where cap rates will be in 4 to 5 years, but when someone's projecting a 4% cap rate right now as an exit cap rate, it certainly gives me pause. And I could be wrong, but I don't want to get in anything with anything that starts with a 4, and preferably like mid-5 exit cap rate. And if they're projecting the returns with that sort of exit cap rate, 5.5, 6, and Sun Belt and some of the Midwest market or the Mountain West markets where I'm primarily invested, I feel like that'll be a good deal and time to jump in. Long
Got
answer.
it. No, that's really, really helpful. I mean, giving us two beautiful pieces of information there. Look at the exit cap rate and the NOI growth assumptions, and see if they correspond to what we're seeing in the market.
We're not going to see 10% a year rent growth. I should have thrown that in there. And some people have said, "Oh, we're going to get 5%." No, it's probably going to be 2, maybe 1. Things are going to calm down.
Right. No, that's very true. And you get the front row seat. I mean, to seeing all these deals come across your desk, and you get to see it from both sides, both from a limited partner perspective and also, from the just the capital stack as a whole perspective. Going, these assumptions either make sense or they don't. I love the way you've put all this together, Paul. It's been a really cool journey just to hear, coming into the commercial real estate space as a broker, figuring that industry out. You taught us a lot about the capital stacks and how we should be thinking of our capital stack and how we should be thinking about that. And then, what your experience has been like as limited partners. So thank you for coming on the show today. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Yeah. Probably my email, or you could just go to stacksource.com. That's probably the easiest. Stacksource.com, and then find my bio and you can get in touch with me that way. I'm also on LinkedIn. That's also a great way to connect, but just our website would be easiest.
Fantastic. We'll make sure we include that there in the show notes, stacksource.com. Paul, thank you again for coming on today. I do appreciate it.
Thanks so much, Sam. Really enjoyed it.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.